Well, it's time once again for a market commentary. Rogers Capital. Hope you're having a great summer. Things are heating up. It's been an interesting beginning to the summer, to say the least. Resilient here in the markets. Resilient but rotating. Well, what do I mean by that? Well, U.S. markets saw modest gains in May and June in continuing to rebound from the tariff tantrum that we saw earlier in the spring. S&P 500 up about 2.1% over that little time frame there, supported by strong earnings, improved consumer discretionary spending, economic outlook. Okay, but leadership for stocks has begun to rotate a little bit beyond the mega cap technology names that have rebounded real well, but we've kind of begun to see Wall Street spread the money around a little bit. Several other conversation points: interest rates. The Federal Reserve just here recently, a couple days ago, holding rates steady at 5.25 in its June meeting, signaling that rate cuts may happen late this fall, and their hopes that inflation continues to moderate. If you know what the Fed is doing, you're the only one who knows what the Fed is doing. What a mystery. After telling us for months and months and months and months that inflation was too high and needed to moderate, here we sit with declining interest rates almost exactly at their target of 2%, and yet they're going to sit here and wait a little longer. Never mind, we've got national debt in the trillions that we're paying 5 and change percent on, and fears of stated anyway concern fears that tariffs will drive inflation. We've had tariffs already. We've had them for a couple months now, and there's really been no sign yet that it's translated to inflation. So we wait and see, I guess. Broader trends that we've been watching: economic growth in the U.S. remains resilient. GDP estimates for the second quarter, 1.5% to 2%, and really even more optimistic than that. 2025, 2026 expectations from an earnings standpoint. What drives markets? Profits. You've heard me say it 1,000 times. Profits, earnings. The earnings outlook. Corporate earnings are not only stabilizing from what was a little bit of a concern, recessionary fears, to pretty optimistic outlook for earnings going forward, particularly industries like energy, financials. So optimism there for sure. Geopolitically, a little bit different story. Quite a bit of risk, ongoing concerns. Obviously, even here, especially recently, with missiles flying, Israel-Iran conflict. Just especially what that might mean and translate to for the cost of energy, and of course, just global war, what that could do. But it's important to remember, yet again, what happens historically following major geopolitical events. 50s, 70s, 2000s. I mean, we've seen this time and time again. And history suggests that markets are higher 1 year later. In fact, 73% of the time. And markets are not just a little bit higher, they're higher on an average about 9% 1 year later. So important to keep that perspective, that history in mind. To the rotation, we're seeing some rotation again from mega cap tech stocks that have led this recent rally. Apple, Microsoft, Nvidia names, Amazon. High growth, high valuation names that have benefited from the AI hype and falling inflation. Defensive sectors like utilities and consumer staples that did fairly well while the market uncertainty was running about. and rotating to cyclical sectors like industrials, energy, financials, companies that tend to outperform as economic growth stabilizes or improves. Small cap, mid cap stocks, which have lagged but are now looking attractive, cheap in relation to large caps, especially techs. Value-oriented stocks, there's growth stocks, the high growth, the usually the more growthy, usually technology type names, no dividend. Okay, stocks. In comparison, you got value stocks, these older, typically strong balance sheet, dividend paying types of companies. Some rotation out of those names we've become so familiar with, especially big tech, into these cyclical, value oriented dividend payer names. So some international rotation as well. But what does all this mean for investors? Well, volatility remains a natural part of investing. It comes with the territory. We're encouraged by an improving economic growth situation and inflation situation. Hopefully the Fed at some point, September, October, maybe they act like it's possible to start reducing rates, which will help. But what does all this mean for investors? A disciplined, diversified process, approach to investing. Allocate, diversify, rebalance. Rebalance into these volatile, these really opportunities to position oneself. So this is the time to stay invested, stay diversified, and lean into opportunities that get created by these hysterical Trump tariff tantrums or geopolitical stuff like we've seen, Israel, Iran. All of that is the case. And then this is year 3 of a bull market. This is especially what happens in year 3 of a bull market. Choppiness. Choppiness happens. So, hope you've got a great summer planned. Hope that you're doing some traveling, spending time with family, and you stay cool. We'll talk to you again soon. Have a great summer.